This is Trading Lesson 57, delivered by Twigbe Ehizoge for Forex, crypto, stock, options, and other chart-related trading. Advised to subscribe, share, like, and make comments or ask questions. You can contact us for training, account management, signal provision, consultation on WhatsApp or call +234 803 7597 085. Trading range traders are scalpers. When the market is clearly bullish, buying near the high, buying a pullback near the high, and exiting higher is an effective strategy. Since the market often goes a long way before there is much of a pullback, when it is in a trading range, buying near the high is usually a mistake, and traders should instead try to buy near the low. When traders cannot tell if the market is a trend or in a trading range, they should look to enter on pullbacks from strong spikes, which is an approach that works well in both trends and trading ranges, and is why it is the best approach for most traders. If the market is forming a bull flag after a rally, look to buy. If it is forming a bear flag after a sell-off, look to sell. It is natural to get confident after some success, and most traders will start looking to add more setup to their arsenal. Also, they hate sitting for an hour or two waiting for the best setup when they see lots of profitable scalp unfolding in front of them. The absolute worst thing to do is to start trading in tight trading ranges. These often occur in the middle of the day after you have been watching for an entry for a couple of hours. They are usually in the middle of the range, near a relatively flat moving average, and they always look so simple. However, they will damage your account and your psyche. Unfortunately, everyone thinks that they can figure them out, and they trade them and wonder at the end of the month why they are down a couple of $1,000. Notice how buying bull breakouts of trading ranges on stops and shorting bear breakouts of trading ranges on stops are not in the list of best trades. In fact, the exact opposites are there. Beginners should not use stops to enter on the breakout of a trading range, since most breakout attempts fail, no matter how good they look. In the trading range, look to buy low and sell high, not buy high and hope for higher, or sell low and hope for lower. If beginners want to trade a breakout, they should wait until after there is a clear and strong breakout, and then look to enter on pullbacks. There is something difficult about every trade, but traders who understand the difficulty can see the opportunity that is present. Traders need to find a style of trading that is compatible with their personality, because if they plan to trade for a living, they need to be comfortable and happy with their job. If they find that they often exit too soon, they should consider placing one cancel the other, OCO order, one to take profit at 2 to 4 points, the other to get stopped out with a loss of 2 points or less. They should then walk away and come back in an hour. They might be surprised that they have suddenly become successful. Great traders don't take most of the setup that they see during the day. They understand that it is not the number of trades that determines profitability. It is simply a matter of taking trades with a positive trader's equation, and you can take few or many. One important component to making money is avoiding bad trades that invariably erase much more than what a trader has earned from good trades. The single most important trade to avoid until one is a skilled, profitable trader is any setup in a tight trading range, especially when it is in the middle of the day's range, near a flat moving average, and the day is not a clear and strong trend day. The first thing that traders should do when trying a new approach is to print out weeks of charts of the time frame and market they plan to trade, and see if their setup appear to be valid. When they begin to trade, they should trade only one futures contract or 100 shares of stock, no matter how large their account is. If they have some experience and are determined to trade large size, once they decide how large a position they can trade, they should trade only about a quarter of that size. If they think they can trade 10-minute contracts, they should trade only 2 or 3. They need to be able to not care about losses so that they can remain objective and continue to trade after a couple of consecutive losses. It is unlikely that they will be able to do that if they are trading their maximum size. Only after consistently making a profit for several weeks to months should they begin to increase their position size. However, most traders take many years to become consistently profitable.